The US obliterated Iran's uranium-enriching facilities yesterday. Iran's options for revenge seem limited, although they have threatened to close the Straits of Hormuz. In the run-up to this event, markets' reaction has been remarkably sanguine. Is that going to continue? Francois, hello.
Hello.
Thank you for joining us. It's very good to see you. Just before we get into the markets, what are your thoughts on what's happening in the Middle East at the moment?
I would say that if you have to consider what is happening, you would have to say that Mr. Merz, who is the chancellor in Germany, maybe said the right thing when he said that Israel is doing the job nobody wanted to do, and they are doing it quite well. At the end of the day, the intervention of the US over the weekend is another stone in the garden of Iran, because on the geopolitical front, they are very limited. We are in a risky situation. As you mentioned, the main issue is the oil price, but even the oil price was not able to sustain a rally overnight. The big question that you need to have in mind is it really in the interest of Iran to block the Strait of Hormuz? And you could consider that even Iran would suffer if such a development will materialize. So at the end of the day, the geopolitical situation is risky. I would say it is under control, and you don't see really any pressure, significant pressure coming that could make the situation worsen significantly, except if Iran goes for a kind of irrational response to what happened lately. This would put the system or the regime in danger, and I don't think that they are going to go that road.
Let's go through the markets now, starting off with petrol, and see if there's any nips and tucks you think you may be making in the next few weeks as a result of the events of this past few days. By the way, crude oil inventories on Wednesday, which may or may not be important, depending on what the Iranians decide to do.
I don't think that it's very relevant, because at the end of the day, the market now is considering what we huge question: is the OPEC Plus able to support supply if suddenly Iran decides to act on the Strait of Hormuz? For the time being, the oil market has been quiet during the night. Yes, it went up overnight, but in the last few hours, the price of oil came down. I think that in general, I am not too worried by oil price. I'm not so much interested into oil price, except if there is something happening in the Strait of Hormuz. Otherwise, I am much more interested in the energy area in general. And I think that this remains a major theme that people should consider for investment. Oil is only part of this investment theme. And this is something that we are considering right now in terms of the way we want to be invested for the medium term.
And how would you do that?
We would do that through a certificate, through investment into a stock selection of companies that are in the different segments of the energy business, and it focused mainly on electrification. We all know that with what is happening with artificial intelligence, energy consumption is going to be significant. It's going to increase significantly in the coming years, and I think that you need to play the ability for the energy sphere to respond to this demand from the major technological companies and AI companies in the future.
Coming to the dollar now, the dollar is up a tiny bit this morning. It's not very convincing. Are you surprised the dollar hasn't gone up more in light of what's been happening?
I agree with you. I agree with you, because it is a safe haven. And it tells you, at the end of the day, the big question that you should have in mind is, okay, now there is this situation in the Middle East. Should I consider that if I was negative on the US dollar, the trade is done and now I should revert my position? I still reckon that the US dollar is going to go lower, and we still have a target of 120 by the end of the year. I still believe that all the conditions are set for the US dollar to weaken in the coming months. And I was very interested by some members' speech on Friday after the Philadelphia number came out, because I think that you can see that there is some discussion now emerging inside the Fed for some quick action by the Fed in terms of interest rates cut. And I think that should weaken the US dollar and support the case that we have made for a lower dollar in the medium term.
Let's look at stocks. Some of the indexes, some of the US indexes are near their all-time highs, although earnings have been very good recently. However, taking in mind the tariffs introduced in the month of April, we have we haven't seen that much sign of any effect in terms of inflation. Does that mean companies are reducing their margins to protect against that, and therefore we would see the effect of the tariffs in terms of earnings in the months to come?
Okay, a few elements when it comes to the US equity market. First of all, you're right. The earnings numbers that were published were quite good. Nevertheless, you can see that you have some earning revision downward. And it means that people are likely reducing their forecast for earnings in the next 12 months. So this is not necessarily something that is very supportive for the equity market, especially because the market has had a strong rally after the lows of April the 9th. And that's the push, the ability of retail investors, people who were short to cover their short, have really pushed the market higher, but there is limited potential from the current level. When it comes to your question about the fact that companies could reduce the margin by letting some price and reduce their margin. I am not quite sure of that. It will be very interesting to see what is happening with the numbers that were published on Friday, the price consumption expenditure index, which is expected to increase a little bit year on year. And I think that don't make the bet that the margin are going to be compressed because companies are going to act this way. It's not necessarily yet the case. You cannot have the evidence that it's going to happen.
I know your thoughts on bonds, especially the longer end of the yield curve on US bonds. What's your comment on bonds and the lack of reaction in the last few days to the events of the last weekend?
It's quite interesting because at the end of the day, normally you would expect that with such development in the Middle East, and if there is some fear in the market, the 10-year bond yield should be the big winner. It has not been. So what does it tell me? It tells me that the main factors that is behind the bond market is still the issue of the US debt and US fiscal deficit, which is so huge that one day or the other it will have to be dealt with. So it's still the main issue. And I don't change my mind. I still consider that the long duration bonds, especially government debt, are not particularly attractive, and you should expect higher yield before considering maybe to purchase them. But there is no point for you to jump into right now and to consider that it is going to decorrelate, and this is something that is going to bring you protection in the current environment.
Gold seems well supported, although the events haven't pushed it to much higher levels. But for those wishing a return down to 3,100 or nicer levels in which to enter the market, they're finding that difficult at the moment. Where do you think now the price point for entry should be in gold if we ever get one?
I still think that the current level or $50 an ounce lower is a good entry point. If you look the different conditions. At the end of the day, again, I still believe that the Fed is going to lower interest rates. It's going to materialize maybe in the autumn. By the autumn, end of the summer, beginning of the autumn, it's going to materialize. And there is room for the central bank in the US to lower interest rates. I still believe that real interest rates are too high. They are going to come lower through the action of the Fed. I still defend the idea that you don't have that many safe haven in the current environment. So I still believe that if you go back to 3,300, there is an opportunity for you to try to get into the market for a target which is minimum 3,500 and 3,800 in the medium term.
In terms of protecting our portfolios, say using options, according to the VIX, not many people are protecting their portfolios with options buying at the moment. The VIX is around 20, which is still very, very low. Is that a good opportunity? And does that mean protection and insurance is very, very cheap at the moment?
It's still cheap. It's not very, very cheap. You can consider that when you are on the VIX around 15, you are very, very cheap. It's still cheap. Yes, if you want to consider that usually, the summer is not particularly good for the equity market, and we are expecting the deadline of April the 9th coming from the US. I still think that at current level, if you are overexposed the equity market, you should consider maybe to buy some protection. If you are, I would say, neutral, if you consider that you are your strategic weight, which is at the end of the day about where we are right now, I still consider there is no point for you to try to protect at that level because there is no reason to fear something major. if you have this development we mentioned earlier in the Strait of Hormuz. But for the time being, I'm not seeing that materializing.
The Fed last week, Jay Powell, he held firm, didn't he? And you said he would, by the way. You said he wouldn't do anything at all. You mentioned that some of the members of the Fed are requiring further rate cuts during the rest of the year. Does that mean you've changed your view on the number of rate cuts we can get before the end of 2025?
I am still hesitating. I still think that there will be at least one cut. There could be two cuts. It depends on the speed of the slowdown in the US economy. For the time being, the signs that we have are very limited that there is a significant slowdown. Nevertheless, we are going to face an economic slowdown. I think that Mr. Powell had an issue of credibility, and he had to show with his declaration that first, he was resisting any political pressure, which he did perfectly well to my point of view. The Fed speech was a very good speech because they were really telling the people what they are looking. They are looking at a situation where there is a lot of uncertainty. This is exactly what we are saying. Uncertainty doesn't mean that you need to cut. It means that you need to be flexible. And for the time being, they kept this position that they are going to be flexible, but they have signs that there is a risk that inflation moves upward. They believe that the unemployment rate is going to stay low and not increase significantly, so they have time to lower interest rates. This is their speech. I believe this is the right speech, and that they will act in September. Normally, they should act and lower interest rates.
Is there anything we haven't covered that you would like to comment on?
Just a few statistics. I mentioned the PCE numbers that are going to be published on Friday. I also going to look very closely at some statistics the sentiment coming from Europe, consumer, industrial service, that is going to come this week. It's very interesting because I still defend the idea that there is a turnaround that is coming in Europe and that you could see signs that the economic situation is improving a little bit, which is something that is also supporting my case for the US dollar to be weaker. And that's mainly the numbers that are going to watch this week. And the PMI, obviously.
Francois, that's all we got time for. Thank you very much indeed. And I look forward to seeing you next Monday.
Okay, you have a good week. Bye-bye, Mark.
Goodbye.